Hello, this is Agnish Bhaduri from Visitex Solutions. Welcome to the first part of the Cryptocurrencies course, the story of money. We believe that it is extremely important to understand the concept of money, its story, the previous mediums of exchanges used, what went right with those mediums, and more importantly, what went wrong to understand why we have arrived at the concept of a Bitcoin. We need to understand why people are calling the Bitcoin the most revolutionary method of payment ever created. And to understand this, let's go back several years. Let's start with 6000 BC, when people started using the barter system. Then we moved on to the coins around 650 BC. We started adopting the first forms of printed currency around 960 AD. The first form of a check came around 1717 AD. PayPal introduced the digital cash concept in around 1998, and finally, the concept of the Bitcoin was released in 2008. So let's start with the barter system. The barter system in its inception was pretty simple, and it was the first medium of exchange known to mankind. The system was logical. Every individual would produce that good or service that he or she specialized in and exchanged it for that good or service that he or she required. Now, this worked well for a while, but there were many flaws that emerged later. The first one was that there was no common unit of value. So let's take a sample case to understand this. Let's say we have two individuals, A and B. A produces rice and B has herds of cattle. Now A and B decide to exchange 10 quintals of rice for one cow. Now, this valuation that one cow is the equivalent of 10 quintals of rice has been decided between A and B at that particular point of time. This may change tomorrow, and A's rice may not be valued as much with a third vendor. So suppose A now wants oranges, and A goes to C who produces oranges. He will now have to come up with a different valuation every time he wants to exchange rice for a different good. So the first main flaw was that there was no common unit of value. Moving on to the second flaw, goods were perishable. This is easy to understand. Cows, rice, these are all perishable goods. They have varying shelf lives. However, if I have one good today, say rice, and I need another good, say a cow, maybe a year later, my rice is not going to last till then. So basically, there was a difference in the timing of demand and supply in the system. The next flaw was that the transportations of goods wasn't as efficient. Again, a very simple point. Transporting large goods was always going to be an issue. And finally, there was no security in the system. Your goods could simply be stolen and used by someone else. You didn't have your own identity on your own assets. Then we approached the concept of gold coins. Men soon realized that gold was a common good that was valued by everyone. And that solved one of the basic problems of the barter system, that there was now a common unit of value. Gold coins were also non-perishable. They also had a very important point, and I would like you to note this down for when we go and reach the stage of the Bitcoin. Gold was non-inflationary. There was always a limited amount of gold reserves in this world. Now, this meant that demand would always keep rising, whereas supply would always be limited. This makes any asset non-inflationary in nature. That means its value will only keep going up. It will never go down. And finally, gold was easily transportable. They were much smaller in size and they were uniform in size. No longer did two different people have to transport two different goods which were different in sizes. Now we come to the flaws. Of course, gold coins weren't perfect, and that is why we don't use them anymore. The first was that they were expensive to mine. Mining gold was not an easy procedure. Second, although we say that they were now smaller in size and easier to carry around, Compare them to today's currency. In hindsight, they were still heavier. Just compare the thought of having to carry your wallet around and a huge sack of gold around. And finally, gold was still not secure. They could still be stolen and used by anyone. That means that they still did not solve the most elemental problem of the barter system, that is security. Next, we came to the concept of paper currency. Now, how did paper currency come around being used? People wanted to solve the issue of security of gold coins. So, they started depositing gold coins with a third party, which we now call banks. In exchange for this gold, banks would then issue an IOU note or a receipt that validates the receipt of this gold. Any person who had these IOU notes could then exchange these for goods elsewhere. These IOUs were nothing but the first form of fiat currency as well. However, their value was backed by an actual physical amount of gold. Now, what were the benefits of the system? First, they were lighter than gold coins and much cheaper to produce. And second, they were backed in value by something. In the initial stage, by a tangible commodity like gold, and later by an intangible commodity like the trust of the government that issues these notes. However, it also had its flaws. The first, again, paper currency did not solve the issue of security. Anyone could steal these notes and then use them again. Second, fiat currencies were inflationary. So, a fiat currency is a form of a currency that is backed by an intangible good, like the trust of the government. Now, because there is no tangible substance backing the value of these notes, a government could print as many as possible. But due to the market forces of supply and demand, the more number of notes that were printed, they would lose their value. Third, black money and parallel economy. There was no way of keeping track of the supply of this money, for what it is being used and who holds it. And that is why they were being used for purposes like creating black money and having a parallel economy. And finally, the gold system, which was done away with in 1970s, because it reduced the flexibility of the central bank to implement the key monetary and fiscal policies required to regulate the economy of the country. We then came to the concept of checks. Now, I believe that the check is very important in concept for the Bitcoin. There are many features that the check has that are very similar to the Bitcoin. First, the check finally improved on the security of the mediums of exchange. It specified the sender identity, the receiver identity, the sender address, and the receiver address. And this point is vital to understanding the Bitcoin later on. The second is that it used a very basic form of cryptography called the signature to validate that it is indeed the actual sender who's authorizing this transaction. Again, a very important point from the perspective of the Bitcoin. And lastly, the user could change the amount. No longer did one piece of paper have to stand for only one unit, like the paper currency. However, the flaws associated with the system were that there was a form of check called the bearer check, and whoever bore that check could actually exchange it for the amount specified. This reduced the security aspect of the check. Second, the form of cryptography being used was too basic, the signature, and eventually they could be easily faked. And finally, the biggest flaw with the check system was the transaction verification time. The verification was done much later. We know the system. The sender gives the receiver the check. The receiver then goes to his own bank at a convenient date and deposits the check. Then the receiver's bank would connect with the clearance authority, which would then connect with the sender's bank, verify that the sender had the amount in his account, and then the transaction would go through. Now, the issue with the system was that at the time of the transaction, the receiver would have to give the sender the goods in exchange for the check. But he did not know whether the sender has that amount of money in his account to fulfill the transaction. We then moved to the system of e-wallets with the birth of PayPal. Now, e-wallets almost seem perfect because 1. There's no need of paper money. You don't have to carry a wallet around anymore. Second, with the current growth of the smartphone industry and the internet industry, and higher levels of cryptography being used, this level of security is much higher. In today's world, almost every phone comes with iris scanners and fingerprint sensors, and these can be used to validate transactions. These are far more superior ways of validating transactions than a signature. Third, they're fast, efficient, and convenient. Transaction verification happens in a couple of seconds, and this solves the biggest issue that the check system had. And finally, e-wallets incorporate a much higher level of accountability in the financial system. Now, this enabled the regulatory authorities to keep a track of the supply of money, who has how much, and what it is being used for. This could reduce the amount of black money and the amount of money being used for illegal purposes. Now, on the face of it, e-wallets seem pretty perfect. They're a relatively new technology, everyone is using them, and they don't seem to have any flaws. And yes, technically they didn't, and they're still very convenient. So the big question is, why did we have to come up with an alternative system, a new upgraded system called the Bitcoin? Well, you see, the main issue with e-wallets, something that is not apparent even now, is that they are still a part of the existing financial infrastructure. Don't understand what I mean? Very few people did before 2008. In 2008, the world saw the errors and the flaws within the existing financial infrastructure. It revealed that there's an inefficient and corrupt financial system in place. The subprime mortgage crisis that happened, due to which financial markets crashed in a domino effect, large investment banks went bankrupt, and the government started bailing out several banks which, to use the correct term, were too big to fail. And finally, there was the largest recession in global markets since 1929. But this was the economic aftermath. And I'm not going to go into the details of what happened in 2008. But let's look at the emotional aftermath of this crisis. People lost faith in the financial systems. The whole point of a bank is to have a trusted third party who's keeping your wealth safe, a better alternative to keeping hard cash at home. And we used to trust them to keep this money safe, but they did not. They misused this money and they lost all of it. This is when people understood that there is no alternative. They started mass withdrawals from banks. And then they realized that there is no substitute to the current system. Either you keep all of your money at home, which in today's scenario is not a great idea, or you give it to a bank whom you can no longer trust. There was a need for an alternative system, a message to be sent to the financial banks that if you do not perform, there is another person we can go to. And then we came to the year of 2008. Towards the end of 2008, a group of individuals or a single individual under the pseudonym of Satoshi Nakamoto released a white paper that was titled Bitcoin, a peer-to-peer electronic cash system. This white paper was so revolutionary, it challenged the very concept of money and the whole concept of having an intermediary to handle that money. There's a reason why we say that the Bitcoin is the most sophisticated and disruptive technology ever invented. In the next few videos, we will look at how the Bitcoin works and why it is so disruptive, and how it proposes to completely replace the current system. I hope you enjoyed this video. Stay tuned for the next video where we will look at how the Bitcoin functions. This is Agnish Bhaduri. Thank you. Hello, this is Agnish Bhaduri from VisitX Solutions, and welcome to the second video in the cryptocurrency series. In this video, we will look at the workflow of the Bitcoin, how it functions, using a very basic real-life scenario. So let's start by understanding the definition of a Bitcoin. The Bitcoin is a digital, decentralized, disintermediated, trustless fiat currency. Now, I have highlighted each and every one of those words because they're each individually very important in describing the Bitcoin. But let's get to that later. Let's take a basic scenario, a real life sample case, if you may call it. A, B, C, D, E, and F are 6 individuals, and they're friends. They hang out regularly and love going to pubs. They all believe in going Dutch with their bills. However, the pubs in their area usually refuse to make separate bills due to the extra hassle. Thus, every time the bill arrives, one person pays the entire amount and keeps the bill to figure out later what amount everyone owes him. This system worked for a while, but soon they started having conflicts. Some members disagreed with the amounts they owed each other, and other people drank more than they could afford, and thus couldn't pay up later. This was an issue. So, A suggested that they keep a common record in a notebook. They created accounts and a common ledger in a notebook and updated it after every session. They used to keep this notebook in a place accessible to everyone. But one day, A realized that some of the numbers didn't match up and some values have been altered. This meant that they couldn't trust each other anymore, and he realized that having a common book simply wasn't enough. He thought about it a lot and came up with a brainwave. So next day, he called for a meeting with all the friends to introduce the new system. He said, "Hi guys, I've come up with a fail-proof method to ensure that we all manage this issue," he says, and hands everyone a notebook. "We will all keep a record of every bill and who owes whom how much. This way, we will all know how much you have in your account, whether you really owe someone that money, etc. Next time, for example, if C owes F a cumulative amount for the past 2 times we went out, we'll check out our entries to see if this is right. And while doing this, we will add up every value and calculate the remaining balance, but we shall not store it. If more than 51%, that is a majority of us, agree that the proposed transaction is valid, we shall approve of it and update our books with a permanent marker and validate this with our signatures. This will ensure that no entry is erased and every entry is validated. An entry's effect can only be reversed by proposing a new transaction to all of us. Thus, if someone wants to cheat the system, he must update a minimum of 4 books in this case without the original owner's permission. The effort and cost required to do this itself will negate any benefits he hopes to make. This way, we don't need to trust each other, we simply need to trust the system. Now, imagine that what they're exchanging isn't physical money, but a form of digital and fictional cash. This is the Bitcoin. Let's examine some of the characteristics that we mentioned in the definition. The first is that it is a digital currency. Bitcoins have no physical form. They're only digital. However, they're slightly different from digital cash. Digital cash is stated in its local currency, whereas Bitcoin is like any other currency. It has its individual value, which is denominated in terms of every individual currency out there. For example, the rupee, the yen, or the dollar. The second point, it is decentralized. Notice how our group in the example shifted from maintaining a common record to maintaining individual records. This is what we call a decentralized database system. Third, it was disintermediated, which meant that there was no one central person who used to oversee the approval of transactions. Everyone in the group gets involved in this approval process, and a minimum consensus of 51% is needed to approve a transaction. Fourth, the system is trustless and anonymous. No friend in that group needed to trust each other to participate. They simply needed to trust the system. Now, the Bitcoin network, unlike our example, don't have public identities. Everyone's identities are hidden, and their identities appear as random alphanumeric codes. This is achieved by a process called the hash cryptography, which we will look at into detail in a different video. Fifth, the system is immutable, which means no previous transaction can be edited. To reverse the effect of a previous transaction, an entire new transaction must be proposed to the system. Fiat. Just like most free market currencies today, Bitcoin is a fiat currency. This means that it is not backed in value by a tangible good, but an intangible good, that is trust. It has value simply because the member of the group believe it has value. They believe that everyone participating in the network will accept the value of this Bitcoin and use it as a legal tender, just like any currency. Except in a currency, the intangible good involved is the trust of the government that issues it. 7. It's cheaper. Since there is no middleman in this picture, and the friends are just using their own currency, they can exchange money at a minimum cost without paying an intermediary. It is also more secure. In our examples, the friends use signatures to identify themselves with the proposed transaction. However, Bitcoins use a much more complex cryptographic method called the hash cryptography to do the same thing. Next, it is deflationary. There is going to be an upper limit of 21 million Bitcoins that will ever be mined. Also, each Bitcoin can be further divided into 10 million units, ensuring that the Bitcoin doesn't fall prey to inflation while ensuring that there's sufficient quantity to transact. Now, this wasn't the first time that the concept of a digital currency was tried out. However, previous attempts failed at solving the issue called the double spending problem. This problem isn't present with physical money. Thus, one unit of digital currency can be replicated, allowing the user to use it more than once. The Bitcoin solves this issue using a decentralized verification model. Thank you for watching this video. In the next video, we will look at the economic side and analysis of the Bitcoin. This is Agnish Bhaduri. Thank you. Hello, this is Agnish Bhaduri, and welcome to the third video in the cryptocurrency series. Today, we'll be looking at the economics of the Bitcoin. There are a lot of videos out there that keep articulating about the technology of the Bitcoin and how it works in the back end. However, at the end of the day, it is still a currency. So let's understand the economic side of the Bitcoin and the various factors that determine its value. So let's look at the agenda for today's video. We'll first be looking at the primary forces, that is supply and demand. Then we will be looking at the allied forces that affect the Bitcoin's value. And finally, we will have a quick discussion about Bitcoin as an asset class. So Bitcoin is like any free market currency. Its value is determined by the market forces of supply and demand. Let's look at the first factor, demand. Now, there are two primary sources of demand for the Bitcoin, like any other currency. First, transactional demand. The Bitcoin has been accepted as a legal tender in some parts of the world. People in these areas use the Bitcoins to make daily purchases, from coffees to cars. The second type of demand is speculation demand. Speculators use the Bitcoin's deflationary nature to gain from it. Most of the Bitcoin's demand is derived from this activity, thus making it more volatile. The Bitcoin tanks when there are instances of profit booking or panic selling. Now, we'll be looking at some of the socio-economic factors that affect the Bitcoin's value. The first factor is one that we've already gone through, demand and supply. The second are drivers of interest. Beyond the specialists initially drawn to the Bitcoin as a solution to technical, economic, and political problems, Interest among the general public has historically been stimulated by banking blockades and fiat currency crisis. Banking blockades. Probably the first such instance was the late 2010 WikiLeaks banking blockade, whereby Visa, MasterCard, Western Union, and PayPal ceased processing donations to WikiLeaks. Following a request from Satoshi, Julian Assange refrained from accepting Bitcoin until midway through 2011. Nevertheless, this event shone a light on the Bitcoin's unique value as censorship resistant electronic money. The most recent such blockade occurred when MasterCard and Visa blacklisted Backpage.com, a Craigslist style list which lists inter alia adult services. Adult services providers whose livelihood depends on such advertising have no way to pay for it besides Bitcoin. The Silk Route is another example of a time when Bitcoins have been used to pay for illegal activity. Fiat currency crisis. As discussed, a Bitcoin wallet can be a lot safer than a bank account. Cypriots learned this the hard way when their savings were confiscated in early 2013. This event was reported as causing a price surge as savers rethought the relative risks of banks versus the Bitcoin. The next domino to fall was Greece, where strict capital controls were imposed in 2015. Greeks were subjected to a daily withdrawal limit of 60 euros. Bitcoin again demonstrated its value as money without central control. Soon after the Greek crisis, China began to devalue the yuan. As reported at the time, Chinese savers turned to Bitcoin to protect their accumulated wealth. The next factor is market manipulation. Bitcoin's all-time high above the $1,000 mark was partly driven by an automated trading algorithms or bots running on the Mt. Gox exchange. All evidence suggests that these bots were operating fraudulently under the direction of exchange operator Mark Karpeles, bidding up the price with phantom funds. The last factor are price irregularities. Sometimes an exchange's price may be entirely different from the consensus price, as occurred for a sustained period on the Mt. Gox prior to its failure and recently on the Winklevoss Gemini exchange. In mid-November 2015, the BTC USD hit $2,200 on the Gemini while trading around just $330 on other exchanges. These trades were later reversed. Such events occur occasionally across exchanges, either due to human error or due to software error. Now, to evaluate Bitcoin as an asset class. Like I mentioned, speculators have been using the Bitcoin for investments for the past years, many years. However, due to the short supply of the Bitcoin in the market, the Bitcoin has been extremely volatile and prone to sentimental trading. The problem is, as all 21 million Bitcoins haven't yet been mined, the value is driven more by speculative demand than transaction demand. Over the past year, I have arranged many conferences on the Bitcoin, and during them, I have received a lot of queries from new investors looking at the Bitcoin as an alternative asset class to fixed income and equity. My advice would be keep a majority of your investments in fixed income and equity and trade the Bitcoin only as a risky growth investment. Use technical analysis indicators based on price and volume metrics and look out for a macroeconomic trigger, something like Donald Trump's election victory in November 2016, for a surge in the Bitcoin's price. Stay tuned for the next video where we will be looking at common Bitcoin related Q&A. Thank you. Hello, this is Agnish Bhaduri from VisitX Solutions and welcome to the fourth video in the cryptocurrency series. In this video, we will be looking at some of the common questions and answers relating to Bitcoin. I have accumulated a list of common Q&A that I've read about and heard from people over the past year of my research on this new technology. So let's start with the first one. And this is a very common question. How are new bitcoins minted or mined? So new bitcoins are generated by a competitive and decentralized process called Bitcoin mining. This process involves that individuals are rewarded by the network for their services. Bitcoin miners are processing transactions and securing the network using specialized hardware and are collecting new bitcoins in exchange. The Bitcoin protocol is designed in such a way that new bitcoins are created at a fixed rate. This makes the Bitcoin mining a very competitive business. When more miners join the network, it becomes increasingly difficult to make a profit, and miners must seek efficiency to cut their operating costs. No central authority or developer has any power to control or manipulate the system to increase their profits. Every Bitcoin node in the world will reject anything that does not comply with the rules it expects the system to follow. Bitcoins are created at a decreasing and predictable rate. The number of new Bitcoins created each year is automatically halved over time until Bitcoin issuance halts completely at a total of 21 million Bitcoins in existence. At this point, Bitcoin miners will probably be supported exclusively by numerous small transaction fees. The next question is, can Bitcoins become worthless? Well, the short answer is yes. History is littered with currencies that have failed and are no longer used, such as the Deutschmark during the Weimar Republic and more recently the Zimbabwean dollar. Although previous currency failures were typically due to hyperinflation, an issue that the Bitcoin does not face, there is always potential for technical failures, competing currencies, political issues, and so on. As a basic rule of thumb, no currency should be considered safe from failures or hard times. Bitcoin has proven reliable for years since its inception, and there's a lot of potential for the Bitcoin to continue to grow. But let us remember that for any currency, even if it is non inflationary in nature, it can become worthless if it is no longer considered a legal tender, which can happen with the Bitcoin if more and more governments keep banning this particular currency. So the next question is, won't the finite number of Bitcoins be an issue if we want to legalize it as a legal tender all around the world? Well, the Bitcoin is unique in that it only has 21 million Bitcoins that will ever be mined or created. However, this is never a limitation because transactions can be denominated in smaller subunits of a Bitcoin, such as bits. One Bitcoin can be divided into 1 million units and up to 8 decimal points, and potentially even smaller units if that is ever required in the future as the average transaction size decreases. The next question, won't Bitcoin fall in a deflationary spiral? The deflationary spiral theory says that if prices are expected to fall, people will move purchases into the future in order to benefit from the lower prices. That fall in demand will in turn cause merchants to lower their prices to try and stimulate demand, making the problem worse and leading to an economic depression. Although this theory is a popular way to justify inflation among central bankers, it does not appear to hold true and is considered controversial even amongst economists. Consumer electronics is one example of a market where prices constantly fall, but one which is not in depression. Similarly, the value of bitcoins has risen over time, and yet the size of the Bitcoin economy has grown dramatically along with it. Because the value of the currency and the size of its economy started at zero in 2009, Bitcoin is a counterexample to the theory showing that it must sometimes be wrong. Notwithstanding this, Bitcoin is not designed to be a deflationary currency. It is more accurate to say that Bitcoin is intended to inflate in its early years, become stable in its later years. The only time the quantity of Bitcoins in circulation will drop is if people carelessly lose their wallets by failing to make backups. With a stable monetary base and a stable economy, the value of the currency should remain the same. The next question: isn't speculation and volatility a problem for Bitcoin? For Bitcoin's price to stabilize, a large scale economy needs to develop with more businesses and users. For a large scale economy to develop, businesses and users will seek for price stability. Fortunately, volatility will not affect the main benefits of the Bitcoin as a payment system to transfer money from point A to point B. It is possible for businesses to convert Bitcoin payments to their local currency instantly, allowing them to profit from the advantages of the Bitcoin without being subjected to price fluctuations. Since the Bitcoin offers many useful and unique features and properties, many users will choose to use Bitcoin. With such solutions and incentives, it is possible that the Bitcoin will mature and develop to a degree where price volatility will become limited. So, the next question: what if someone bought up all the existing Bitcoins? This is a really interesting doubt. To answer this, only a fraction of the Bitcoins issued to date are found on the exchange markets for sale. Bitcoin markets are competitive, meaning the price of a Bitcoin will rise or fall depending on supply and demand. Additionally, new Bitcoins will continue to be issued for decades to come. Therefore, even the most determined buyer could not buy all the Bitcoins in existence. The situation isn't to suggest, however, that the markets aren't vulnerable to price manipulation. It still doesn't take a lot of money to move the market price up or down, and thus Bitcoin remains a volatile asset thus far. Next question: what if someone creates a better digital currency? Well, that can happen. In fact, there are thousands of more cryptocurrencies than the Bitcoin. For now, Bitcoin remains by far the most popular decentralized virtual currency. But there can be no guarantee that it will retain that position. As I mentioned, there are already a set of alternative currencies which are inspired by Bitcoin, such as Ethers, Ripple, etc. It is, however, probably correct to assume that significant improvements would be required for a new currency to overtake the Bitcoin in terms of established market, even though this remains highly unpredictable. Bitcoin could also conceivably adopt improvements of a competing currency, so long as it doesn't change the fundamental parts of the protocol. The last question in this video is a really interesting one and one that I've encountered on several conferences. It is, aren't cryptocurrencies simply reversals to the barter system? This is a really interesting question. And the answer is, it is in a nutshell, because essentially we are providing services and goods to the system or the economy and receiving goods and service in return, except here we are monetizing the value of those goods and services in a new form of cryptocurrency. This may sound like the barter system, but it is not much different than the system we follow today. We are using a common unit of value to quantify and validate different goods and services. Thus, you can call it a barter system with the advantages of the current system and fixing upon the flaws of the current system by making it more accurate, more transparent, and giving more power to the people. So, thank you, and stay tuned for the next chapter, the future outlook for Bitcoins. Hello, this is Agnish Bhaduri from Visitex Solutions, and welcome to the second video in the blockchain series. In this video, we will be going through the concept of blockchain. We'll be understanding some of the basic functionalities, and finally, we'll be looking at some of the competitive advantages it has over the current day systems. So let us start with understanding what is the blockchain. Well, first, the blockchain is simply a distributed database system. Second, if you look at the technical definition, it says that the blockchain is a distributed peer-to-peer ledger. If you've been through the previous video, as we've discussed, a distributed system is one where every participant is a point of authority and they are all equal in nature. And it is through their interaction that the system is supported. Finally, the ledger word comes in because the blockchain is nothing but a registry of transactions of various sorts, as we will see later. Now, every participant within the system has a complete version of the database, or to be more technical, a ledger of the transactions. So every participant has an insight into the complete list and history of transactions that have happened in that particular network. This is what puts in the factor of transparency in blockchain systems. Then, every transaction is declared valid only and only after it has been cleared by a majority of the participants in the network. There is a consensus required to validate any transaction in the network. This is done with consensus algorithms and hash cryptography. This ensures that hacking the system is economically unfeasible and only those transactions or decisions go through the system which are cleared by a majority. You can think of this as a democratic system of sorts, but that's just my take on it. Then, the blockchain can transfer any item of value. It does not have to be a cryptocurrency or information. Any item that carries any form of value, any asset, can be transferred across the network. It is simply the rights that are being transferred. Next, the blockchain is the underlying technology behind the Bitcoin. This is how the blockchain was invented. In fact, in 2008, when Satoshi Nakamoto released the white paper on peer-to-peer systems called Bitcoins, people first experimented with the concept of Bitcoin and then realized that the underlying technology behind the Bitcoin can be used for many other purposes. And this is what came to be known as the blockchain. And this brings me to my final point. And this is a really important point if you want to understand the blockchain course properly. And it is that the blockchain is not the Bitcoin. Now, I have taken several conferences and seminars over the past few months, and I have faced this issue repeatedly where people cannot pass the barrier that the blockchain and the Bitcoin are the same thing. So I would like to reiterate this. And it is that important a point that the blockchain is not equal to the Bitcoin. Now, why say this? It is simply an application of the Bitcoin. I would look at it as Facebook and the internet. The internet isn't Facebook because the Facebook is simply an application that uses the internet. Similarly, blockchain as a technology offers multiple use cases in various industries. Any industry that faces an issue with the safety of records and data and could use the elimination of middlemen is an industry that is viable to be disrupted by the blockchain. Thus, to again reiterate, blockchain is the technology that surrounds the Bitcoin. The Bitcoin is simply an application that uses the technology called blockchain, and the blockchain can be used for many other purposes, as we will now see through our use cases in different videos. Now, a blockchain enables its participants to transfer any item of value. These can include cryptocurrencies, cars, information, intellectual property, anything. every user is connected to every user, and multiple copies of the records are maintained to ensure transparency and safety. The lack of middlemen in these systems drives down costs. Thus, all these features make the blockchain a safer, more secure, and cheaper method of transacting. So, let us sum up some of the advantages that are highlighted. The first, there is disintermediation. The system is self-supported and it depends on a high number of users to ensure a smooth functioning. It does not require an intermediary to validate transactions or act as a third party. This is very important because in an ideal situation, middlemen simply drive costs up and reduce efficiency. They also slow down the system. Second, empowered users. All the users have equal power and there is no hierarchy. In fact, the hierarchy is flat. Thus, every user is in charge of verifying transactions and keeping the system self-sustained. Third, process integrity. There is a systematic procedure for verifying transactions, and this makes users trust the system. Fourth, transparency and immutability. Let us talk about immutability first. The concept of immutability states that any previous records and transactions cannot be erased. What this ensures is that there cannot be any fraud because you cannot go back historically and change the value or any particular record to your own gain. To reverse any previous transactions, a new transaction has to be proposed to the network and then approved by every participant in the network. Fifth, there are faster transactions. Now, although this isn't true as of today, as systems such as Visa and MasterCard are much faster in processing transactions, the blockchain networks are becoming faster and evolving. As I mentioned earlier, it is still a nascent technology. It is still stabilizing. But as more and more users join the network and there is an increase in the number of miners, the transaction time will keep improving and finally it will beat the current systems. It will thus be the fastest system available once the sufficient number of people have joined the network. And finally, the system is cheaper simply because there is no intermediary. And this is going to have a downward pull on the cost. So to sum up, the blockchain might be cheapest, the safest, soon to be the fastest, the most transparent system that ever existed. It gives more power to the people and puts less power or takes away all the power from intermediaries. Think about today's world. Intermediaries exist everywhere, from your bank to the government to sales, everywhere. And although till date we have thought of their function in the entire production process to be really important, if there was a way that technology can substitute their function, it would be a win-win for the producer and the consumer. And that day has finally come. The blockchain is the technology that will reduce our dependency on intermediaries. Thanks for watching this video on the blockchain basics. We shall now start examining the different use cases of the blockchain and looking at the business landscape. We will look at different companies, investments, and where the industry of blockchain is headed into the future. This is Agnish Bhaduri from VisitTech. Thanks for watching this video. See you in the next one. Thank you.